In the world of global finance, rules come and go. They get updated, replaced, and forgotten. But today, we're talking about a true survivor, a standard that was officially supposed to be obsolete but just refused to go away. Let's talk about International Accounting Standard 39. But before we get into the weeds, let's start with a really basic question. How does a massive global company, one dealing with dozens of currencies and facing interest rates that bounce around every single day, how do they protect themselves from a sudden financial storm? Well, the answer is all about the rules, and that's where our story begins. All right, so to really get why these rules are so important, you first have to understand the world these companies live in. Any business that operates across borders is basically sailing on some seriously choppy financial seas. Really think about it for a second. A surprise jump in interest rates, that could absolutely hammer the value of your investments. A sudden drop in the euro? Well, there go the profits from that big European sale. These aren't just little bumps in the road. They are constant, huge, unpredictable risks. And for these companies, managing that chaos is priority number one. So, how in the world do you bring some order to all that financial chaos? Well, you write a rule book. A really, really big one. And for a very long time, that definitive rulebook was IAS 39. This thing came out way back in 1999, and it was a huge deal, a real attempt to create a single global standard for financial instruments. But, as you can probably guess, trying to regulate something that moves as fast as global finance meant the rulebook itself was incredibly complex, and they had to keep tweaking it and adding amendments just to keep up. But look, IAS 39 wasn't just about tracking numbers for the sake of it. Its real mission, its whole reason for being, was to provide the framework for a really powerful risk management strategy. It's called hedging. So let's break down what that actually means. Okay, first up, you've got the hedged item. This is the thing that's actually at risk. It could be an asset you own, a debt you owe, maybe even a big purchase you're planning to make down the road. It's the thing you're trying to shield from those financial storms we were talking about. All right, so you have your at-risk item. Now you need something to protect it, right? That is your hedging instrument. And honestly, the best way to think about it is like an insurance policy. It's a totally separate financial tool, usually a derivative, that you buy because you expect its value to go up when the value of your hedged item goes down. They balance each other out. And finally, you have hedge effectiveness. This is basically the report card. How well did that insurance policy actually work? The rules in IAS 39 are pretty strict on this. For your hedge to even count, it has to be proven to be highly effective at canceling out the risk. So what does this actually look like? Well, the standard lays out three main types of hedges. First, you've got a fair value hedge. This protects the value of an asset you already own, like if you're trying to protect a bunch of bonds from rising interest rates. Then there's the cash flow hedge, which is all about the future. Think of an airline locking in today's price for jet fuel they won't even buy for another 6 months. And lastly, you have a hedge of a net investment, which is what a big multinational company uses to protect its profits from an overseas branch when the currency exchange rates go wild. For years, IAS 39 was king. It was the rulebook. But, it was complicated, and a lot of people thought it could be simplified. So a massive project began to replace it completely, which brings us to a tale of two competing standards. And man, this timeline right here, it really tells the whole story. So you see, IAS 39 is born in 1999. A full decade later, in 2009, the big project to replace it officially kicks off. Then, in 2014, its successor, IFRS 9, is issued. Seems pretty straightforward, right? The old standard is out, the new one is in. But then, look at that last point on the timeline. Somehow, the old rules are still an option. And this is where the story gets really interesting. This is the big twist. After a decade-long project to create a replacement, why on earth is IAS 39 still with us today? The answer is pretty wild. It all comes down to an unexpected choice that was given to companies. The reason is hiding in plain sight, right here in the official text. The new standard, IFRS 9, actually says that a company can choose to keep using the old hedging rules from IAS 39. That's incredible. It's basically a get-out-of-jail-free card. And a lot of companies, when faced with that choice, just decided that for their tried-and-true hedging strategies, the old familiar rules were just a better and more predictable fit. So yeah, IAS 39 survived the chopping block. But it's not some dusty old relic just sitting on a shelf. No way. It's actually in the thick of things, playing a critical role in one of the biggest financial shifts happening in the world right now. You've probably heard the name LIBOR thrown around. For decades, it was a cornerstone interest rate that trillions, with a T, trillions of dollars in financial contracts were tied to, everything from mortgages to massive corporate loans. Well, LIBOR is going away. It's being phased out globally and replaced with new rates. And as you can imagine, this is a monumental headache for, well, pretty much everyone. And guess which rulebook they pulled out to help manage all of this chaos? You got it, our survivor, IAS 39. Regulators actually went in and amended it specifically to give companies some practical relief during this transition. These changes basically gave them a lifeline, helping them avoid tearing up their existing hedges and creating a stable accounting bridge during a time of massive uncertainty. And just to be clear, we're not talking about ancient history. The most recent major update to IAS 39 to deal with this exact issue happened in 2020. That is definitive proof that this so-called old standard is very much alive and kicking in today's financial world. When you step back, the story of IAS 39 is just a fascinating look at how rules can evolve and sometimes endure against all odds. It really leaves you with a pretty cool question. In a world that's always chasing the next new thing, what makes a rule so solid, so useful, that even its own replacement can't quite take its place?